Hi, I'm your host, Bob Powell. I serve as the editor of the Institute's Retirement Management Journal and the editor of the Street's Retirement Daily. In this episode of the Exceptional Advisor podcast series, my guest is Paolo Sironi. Paolo is an elected member of the IBM Industry Academy and strategic advisor to selected IBM global accounts, promoting Fintech thought leadership worldwide as spokesman for innovation. In this capacity, Paolo mentors CEOs and top managers of financial institutions as well as key startup entrepreneurs on a host of business issues related to digital transformation, artificial intelligence, quantitative finance, and open banking. Paolo is also research associate of the University College London Center for Blockchain Technologies and an active member of the advisory board at selected financial institutions. He's also the author of 4 books: Modern Portfolio Management, Value Generation for Investors, Fintech Innovation from Robo-Advisors to Goal-Based Investing and Gamification, and his latest book, which was published in 2019, Financial Market Transparency, Theory and Principles, which addresses the biological underpinnings of finance and banking. I had the pleasure of first meeting Paolo at a Pension Research Council conference at Wharton in 2018, and I'm here to tell you that you're in for a treat. So welcome, Paolo, to the Exceptional Advisor podcast. It's a pleasure to have you on our show.
It is my pleasure.
So for the benefit of our listeners who may not be familiar with you and your work and the books you've written, do you mind giving them and me a brief overview?
Well, I used to be head of risk management for investment banks. I became a startup entrepreneur to build a digital wealth management solution B2B. And then I sold this small company to IBM 5-6 years ago. And now I am the global fintech thought leader of IBM, with a special focus on understanding the industry's transformation in financial services. And as I took over this role, which is a role of discussing with the industry what is really going on, I also became an author of literature, a bit of quantitative finance, a lot about investment management and wealth management. I think 2 books of mine might be relevant in this conversation. The first one is the Fintech Innovation, as a subtitle, From the Robo-Advisor to the Goal-Based Investing and Gamification. I would say the worldwide bubble of robo-advisor. And the second one, which is my last book that was launched this year in Davos during World Economic Forum, is titled Financial Market Transparency, which is a novel theory of finance and economics that positions financial planning and advice as the core of a new model for central banks, financial institutions, and regulatory frameworks to generate value for customers.
So with your latest book, which was published in January of this year and is available on Amazon, as is all your books, there's a description in the book that says that financial market transparency's breakthrough is in recognizing Homo sapiens as both rational and irrational while facing uncertainty, and that this biological approach overcomes both restrictive neoclassical hypothesis of rationality and behavioral finance's incomplete attempts to nudge investors. And you propose a novel micro foundation that describes the biological nature of financial markets to increase one of my favorite terms, anti-fragility, and that readers will make a better decision under uncertainty that will profit us all. So I'm eager to learn more about your latest book and how to benefit or make better decisions.
Well, you see, this book wants to answer a call for help made by Alan Greenspan in 2009 in front of the US Senate committee when he was asked to comment about the global financial crisis, what was going on, why we were having a crisis at the time. And Alan Greenspan did what is now called the radical candor. So basically said, I realized that there is a flaw in the theory. That means the agents, the investors are not rational. So markets with more or less regulations cannot become efficient. And he said, I'm distressed by the fact that it has worked for like 40, 50 years and it doesn't work anymore. So now this is exactly what happened at the time. So the industry has been growing on very weak foundations. They did not recognize the way uncertainty plays in terms of investment decision-making processes. So it required to define a new framework, a theoretical response that could be a practical theory to create a new business model for banks which are centered not on financial markets, but on the reality of the Homo sapiens, so the human being, because the Homo economicus, so the homogeneous rational investor, effectively does not exist. And that's why I embarked into this research project that enabled me to deep dive into the neurobiological micro foundations of investment decision making, and out of that build up a journey that defines what the new business model of financial institutions should be to generate value for clients using holistic behavioral awareness as the core solution to justify the fees, basically a planning mechanism centered on goal-based investing and agnostic probabilities that can effectively help the investor to understand how to position in front of the instability. Because you see, instability is the norm in finance. It is not the other way around. So the first thing that a financial advisor has to recognize and help the client to understand is the fact that uncertainty is endogenous to our decision making. This way we avoid exuberance, we avoid to run after the latest piece of news, and so we don't fall in the trap of buying high and selling low that happens very frequently in the world of retail and affluent investing.
So as I look at the table of contents in the book, there are several chapters, theory and principles of financial market transparency, anti-fragility in the presence of fundamental uncertainty and holistic behavioral awareness, information asymmetry and the transformation of investment relationships. Do you care to speak to some of those chapter headings?
Yeah, so let's first of all set the tone here. What it means to define the neurobiological macro foundations of financial markets. The human consciousness emerges from our spatial biological relationship as Homo sapiens with these two micro foundations, which are fundamental uncertainty and the irreversibility of time. Let me try to explain these two in simple language. Fundamental uncertainty means that we are asked to survive. We might forget that when we live in New York or in Los Angeles, but basically we are Homo sapiens, right? So as we open the eyes on this planet, we have to survive. And if you think about investing, also your money has to survive, right? So money is a mechanism that humanity has created when we were primitive Homo sapiens to facilitate our survival, because by using money, we can do trade. We are not forced to be a hunter, to do agriculture, to take care of the family all at the same time within the same day, and time is not enough, right? And as we forgot that, we started thinking that money is a rational element, and instead it's not a rational element. We can discuss that afterwards. It's really emotional because it's linked to our need of survival. So basically, when an investor invests the money without realizing, he puts the money somewhere else. And so the money is really exposed to fundamental uncertainty, right? So there is like a warning mechanism in your biology that raises the flag saying, hey, watch out. You don't know anything about the future, or you might fool yourself in thinking that you know about the future. Is a survival problem. So now, fundamental uncertainty therefore defines the survival mechanism. What is irreversibility of time? Irreversibility of time means that time goes only in one direction. We are born, we do things in life, and then we live to die. And likely and hopefully, we take care also of the next generation, which can be our children or the planet in general. Now, you see that the scope in life is not to be happy per se, because maybe money gives you happiness, but when you have a lot of money and you don't have purpose, you're not happy ultimately, right? So you're not satisfied. So the irreversibility of time is the one that defines the need of purpose in life, but also the need of being responsible in life. What does it mean? It means that if you make an investment, and you lose the money. It's not that they can give it back, right? So you need to be responsabilized because you cannot go back in time and call it back as long as it is not a fraud, of course. And I'm assuming that we're not talking about frauds here today. Therefore, you need to become more aware as an investor of the fact that time goes in one direction only. So when you make a decision, you will have to face the consequences. The world is unstable every day more so. Instability is the norm in financial market. As much as you have to survive as a human being, your money has to survive as well, because it's one of the mechanisms that humanity built for survival. So awareness about this is the first starting point. Now, why these two micro foundations, fundamental uncertainty and irreversibility of time, matter so much in finance, being one of the pillars for the definition of human consciousness? Because what is finance? Finance is nothing but trading uncertainty over time. Even risk is an approximation of how much we can gain and lose. And what matters is what we cannot measure with risk, which is the fat tail, the black swan, what is out, which we keep on forget. Because as human beings, we don't want to think about uncertainty too much. That's why we make a lot of mistakes when we make investment decisions. So if finance is essentially an industry that trades uncertainty over time, since human consciousness is based and grounded on our biological relationship to fundamental uncertainty and the reversibility of time, finance gives us a wonderful case study to understand human consciousness. And I can tell you something else. A lot of your audience might be financial advisors or planners. They need to take care of asset allocation perspectives. Some of them, or most of them, will want to deal with model portfolios, optimization theory and methods. Now, I presume that a lot of the guys in your audience tried an optimization technique but never really used it in practice, right? So there's a lot of criticism about the fact that the mean variance, Markowitz, Black and Litterman models are effectively biased or ineffective. And you know why this is so? Because the efficient frontier that everybody talks about has two drawbacks. Uncertainty is exogenous to the efficient frontier, and the efficient frontier is atemporal. It doesn't help you to differentiate your investments according to the time horizon. So how do you solve this? Well, this explains why the goal-based investment principles or the goal-based wealth management is more appropriate, because being based on the time horizon where you position goals, because goals occur over time, it maps more clearly the need of purpose for people and their investments, which is very relevant today in finance. And if you ground it on proper quantitative techniques, which accept the agnostic simulations, that means your autoreferential opinions about the view of the financial markets come second, not first. So you accept that instability is the norm, and your research is a qualified opinion, but cannot be a fulfilled prophecy. Therefore, you start remapping the way you define planning and advice on the same grounds of human consciousness and our biological setup for making investment decisions over time under uncertainty.
So in the book, Financial Market Transparency, you also talk about the two things. One, the stochastic simulation of future returns, and also the value generation for investors with heuristics in relationships as an open system. Any care to chat about that for a second?
Yes, so let's start with the open system. How do we make decisions? Well, basically, our brain is like an optimization mechanism, right? Absorbs data and information, needs to assume at some point that data is enough, so it can make a prediction. So we make a decision, we move, or we do something. Now, when we drive, we assume that we have enough information to drive the car. Then we take the phone and we start looking at Facebook, and all of a sudden we fool ourselves because we do not consume enough information to drive safely, and we crash, right? So because uncertainty raises all of a sudden. The key element is that when we invest, our brain gives us signals saying, watch out, because the future is open. Instability is the norm. You really don't know what happens, which is the reason why a lot of people have a harder time in understanding finance, because in essence, just to say it in a silly way, there's nothing to understand. So the future is open. Nobody owns it. Okay. Not even the best investor, because it can be good one year and then it may not be good the next year. So now our brain, to solve the problem, does the following: starts assuming that uncertainty is not part of the equation so that it can make a decision. Because otherwise, the brain will stall, because we'll have to consume all of the energy in our body trying to figure out if information is sufficient to make a decision. So it's very human to do the following, which is the reason why we always underestimate the black swan, because we tend to find a simplified way of doing, though the brain is very efficient, in order to move forward and to do many activities during the day in our thinking and speculation and so on and so forth. So now, if instead we want to make sure that we become anti-fragile in the way we invest, so that some of our investments will die because we made it wrong, but we will survive as individuals because we carefully balance all of the buckets and the mental accounts. We need to embrace uncertainty, making it endogenous to the decision-making framework. So in order to do that, I need to have a quantitative mechanism that is supporting my decision-making process, that doesn't get fooled by subjective opinions, which is the agnostic simulations of the future returns, or the probabilistic scenario simulation based on agnostic returns. Agnosticity means that at least in finance, where we can get an approximation to this definition, you cannot add into the equation your subjective views or your risk premium that will basically modify the way the future look like, because those are opinions that you need to compare with the fact that as time goes by, effectively uncertainty might grow. So all of these elements enable you to do something which is very important. The black swan that Nassim Taleb, who is a genius, is really somebody that I highly respect, can be brought inside the decision-making process for everybody. So it's not just something that works for a super investor, but we can build a decision-making process that enables us to bring uncertainty, to remind us at every time that we cannot be exuberant, because effectively we don't know. So our investments become more robust. In essence, we cannot optimize portfolios. What we should optimize, in brackets, that means improve, is the investment decision-making process, which is the reason why the relationship with a good financial advisor, especially a good financial planner, is so important to create value for humans, to relate with the fact that money is emotional, is not rational, therefore to create in this conversation holistic behavioral awareness, which the client should be willing to pay for.
So it strikes me that if you're an advisor and you're not doing some of these things for the benefit of your client, what should they be doing, or besides reading your book, I suppose, but are there processes for them to adopt, or training for them to pursue, or study groups?
Well, there are also processes. My third book of four is titled MiFID II Value Generation for Investors. Now, it starts from the European perspective, the MiFID II regulation, but it's not restricted to Europe. It's just that the MiFID II is like New York. If you can make it there, you make it everywhere, because it's very demanding regulation. But that clearly defines a process for financial advice and planning, which distinguishes the moment of client onboarding, which is ongoing onboarding, is the conversation about his needs, about his wealth, about his non-financial assets, and the inboarding of the investment solution, which is equally important. The two need to relate one to the other. But ultimately, as the embedded commissions on products are racing to zero, and as you see that there is kind of a tendency towards passive investing, which has the lowest commissions in the realm of investment opportunities, the remuneration of the planning exercise and the advisory perspective comes from the onboarding of the client. But only if you can demonstrate that continuously onboarding clients through the conversation, you generate value for the client, you can get the client to pay for that. So institutionalizing this process and also using technology to support this process as an augmentation of the advisory model, which is run by humans, is very important, because it's difficult for clients to understand the value proposition. And the reason it is difficult is because biologically, again, we need to look at the biological reality of individuals. We have a hard time in dealing with finance because as humans, we have a hard time in dealing with uncertainty and fundamental uncertainty. So our brain found its own shortcut in order to let us be optimistic, but the financial problem brings it up on our face. And therefore, we tend to, misunderstand some of the concepts. We tend to become very anxious, and the work of the financial advisor and planner becomes very difficult. That's why some people say that the advisor and the planner is like a psychologist or a coach. They don't really understand why I'm explaining to you why, because they really need to deal with this biological element of the individual.
So that raises a question for me, which is clients are going to advisors to perhaps deal with uncertainty, or in hopes that the advisor has more certainty than they do about investment decisions, asset allocation, etc. But these very same advisors are also human and potentially suffer from the same problem of living in an uncertain world. What is that fair to say?
That's well. You see, that's why the title of this book is Financial Market Transparency, because if you're very transparent with your client, you acknowledge with him that you yourself, you don't own the future, which does not mean you cannot add value, because the value comes from helping the client to relate with this uncertainty and to shape the investment solutions in a way that can correspond to survival, to performance, and to aspirations. Basically, is the Maslow pyramid, right? Because if you forget that, you're not going to be a good investor. You know yourself that Warren Buffett has a lot of liquidity. And many people criticize him because they say you're not efficient, because liquidity doesn't bring you to the efficient frontier. But the reason why Warren Buffett keeps it, because he goes, liquidity gives me comfort to make the right decision, because otherwise I might decide in a hurry. Now, typically, liquidity cannot be remunerated by advisors because they have a mechanism of remuneration, which is percentage of the asset under management. But in the planning context, where the value comes from helping the client through this process continuously, because it's ongoing, even liquidity, which maps into the security, can be effectively remunerated. But that means understanding deeply what the goal-based investing means, which is the heart and soul of most of my literature, and has been discussed from a technological perspective, a quantitative finance perspective, a process perspective, and in this last book, a business model biological perspective.
So 2 more chapters in the current book. One has to do with the shift from reductionism to holism, and also the cost-benefit analysis and value generation for investors, which perhaps we just touched on a little bit, but perhaps you could elaborate on those topics.
Okay, holism and determinism, we can see it in 2 different ways. We start discussing the industry transformation, and then we get into the problem of negative externalities, the long-term synchronization with the planet problem like global warming, so on and so forth. Now, the industry perspective is the following. The global financial crisis created a peculiar situation in financial markets and economies. So basically, the central bankers had to intervene to save the system, like it or not, they pumped a lot of money into the equation, and therefore interest rate raised towards zero or negative in some countries in Europe, like Switzerland or Germany. And there is an expectation that this is happening also in the US 2-3 years from now. Now, at the same time, the regulators raised the cost of capital for banks, which means that after the price for risk, with so low interest rate, there's no much value for the shareholders of banks coming from the interest rate margin, which is lending operations, which is the reason why now the banks are not anymore an efficient mechanism for the transmission of the monetary policy. That Ray Dalio himself suggests that central banks should start giving money directly to the economy. And even the governor of the Swiss National Bank, the Central Bank of Switzerland, Mr. Jordan, said that if you fast forward with stable coins, you will see that effectively central banks will become commercial banks, right? So now you've been studying banking, learning that banks are credit institutions, then do other things like payment and investment management and insurance under bank insurance framework. Now you're seeing that a lot of banks are now moving from interest rate margin towards the intermediation margin, especially wealth management, because payment will bottom in terms of marginality with instant payments anytime soon. But what happens here is that even in this territory, things are not that easy, because there is more and more transparency, the vanguardization, so the reduction of the embedded commissions. Everybody is trying to figure out how to ask clients to pay differently and to pay more, and to pay more that means pay for the relationship. Even Goldman Sachs is going through this transformation from capital markets towards wealth management, yourself. So it's a deep transformation of the business model of banks that cannot succeed if the regulators and the central bankers don't understand it. Now, the issue for you and your audience here is the following. If you pretend to be economically sustainable just to do wealth management by delivering model portfolios or asset allocations, you can still do something today, because in the past the industry was purely product mechanism. Now at least it's a portfolio mechanism, but the asset allocation is commoditizing. It doesn't enable you to differentiate in front of the client, so that the client recognizes you as an advisor to be in sync with the individual needs that the client expresses or needs to express. So where does this personalization come from? Well, if you cannot remunerate the credit operations with the interest rate margin, what you can do is to price the risk management cost, but then bring the liabilities inside the advisory conversation, because we might be all equal in terms of assets, because that's capital markets, but we are all different when we look at the liabilities. So that's when planning emerges, like the only mechanism that enables you to discuss with the client is financial life and generate value that makes sense. But planning is holism. It means that you don't look at one vertical only. I look at real estate. I take care of capital markets, but not fixed income. I do the retirement. It can be. You need to have everything under the same umbrella to be capable of justifying the fees, which is more and more important when we look at the platformification of finance, because we will not find the real unicorn in fintech if we don't find that one capable of reaggregating all of these under a planning mechanism, which I called in the American Banker article that was published 2 weeks ago, the open banking advisory platform. Now, the same shift towards holistic banking to justify the fees into this planning mechanism needs to happen in our decision-making process. Technology was not that great 50, 60 years ago. So we used to treat problems more deterministically, right? So one problem at a time. But now we have powerful computing, we have cloud, we have quantum computing, which is improving every day. So we need to find a way to make decisions by looking at the whole lot. A lot of economists discuss the fact that the world is interconnected and global, and you cannot break it, you cannot build barriers. But then when they articulate their language, which is not really predictions, but expert opinions, they talk about exogenous shocks. Now, for an American economist, what happens in China cannot be exogenous, right? Because China doesn't live alone on this planet. So we need to start thinking more broadly and more holistically, which is also happening when it comes to the global warming problem. The problem of global warming is not just the consequence of one action, but is a concomitant contribution of a variety of different actions that we do on the planet. They need to be considered in order to understand how to mitigate this issue. Some discuss, for example, that digital has a positive impact on the decarbonization of the planet. Others say instead that the cost of energy to run all of these computing centers will have a negative impact. Basically, yet we don't know. So we need to aggregate as much as large thinking as we can possibly do in order to make sure that we embrace more fundamental uncertainty. And if you're not certain, we don't get fooled by our predictions, but we save a piece of, if you like, our investing, our saving, our business plan, in order to accommodate for the needed flexibility to remain anti-fragile, not to start believing into something that becomes unfulfilled, and then the framework, the theoretical framework and the investment portfolio breaks and collapses.
So, do you want to chat a little bit about fintech innovation?
Yes, we can get into the fintech innovation. I only want to add something. Talking to so many wealth managers worldwide, there's a trend which is happening. It is evident that fundamental uncertainty is rising on the world stage. Okay, we have a lot of political uncertainty, we have a lot of economic uncertainty, we have a lot of social uncertainty. Under this climate, expert opinions are not enough. Clients already had a hard time in following the complex language of finance. Today, that's very disconnected from their real concern. So some of these are deciding to position discussions about fundamental uncertainty, which is well described in my financial market transparency theory book, as one mechanism to convey value to clients, to help them understand that even though uncertainty is very high, still they can make investments and follow those investments in order to attempt to be successful. Now, the fintech innovation, which is my second of four books, is really dedicated to the digital transformation of the industry, with this special look at wealth management, because as I said, I believe it has the secret sauce to fully digitize financial institutions around the planning concept, where on a platform you can aggregate data and elements which typically sits on different silos in a financial institutions to create with digital a better planning and advisory experience and engagement for the client. But the core of the fintech innovation is the explanation why robo-advisors, as they were initially configured, could not be successful, and they were not successful. I remember conversations with guys like those of Betterment 2-3 years ago, and I was indicating that without human advisors, they would not be capable of growing if they didn't have an established engagement and brand with the client, because marketing is very expensive and trust is difficult to build. So why, therefore, a lot of these fintech entrepreneurs believe that they have the most convenient investment mechanism available on digital, which is maybe transparent or maybe engaging or a good experience with the client, yet the clients are not onboarding as fast as they thought. For this simple reason, that technology mobile is a pool technology. That means a technology of the demand, while wealth management is an industry of the offer side, is a push industry. So effectively, investment solutions are pushed to people. I give you this example. I live in Frankfurt and my family is in Milano, in Italy. So I travel from Germany to Italy every weekend. And the first thing I do on Saturday morning is grocery. That's my role in the family. So when I go to the supermarket, what do? I pull from the shelves my milk, my pasta, my beers, and then I might see an advertisement of George Clooney shampooing his beard. I have a beard, and I like that brand. And I say, okay, I buy it. But because it's pushed on me. But when I go to the cashier, something interesting happens. I look at the product I put in my trolley, and 95% is always the same, right? The same milk, the same semi-skimmed milk, the same brand of bread or beer, and so on and so forth. Because grocery is largely pull. That means more or less I already know what I want. And then, Procter & Gamble pushes advertisement at me, trying to modify my behavior. You never told me, Paolo, let's take a look at what is going on Amazon. What is going on Amazon? Nothing. All of the audience of this podcast is now there trying to buy one of my books, and maybe Jeff Bezos wants them to buy a different book. Fair enough. There's better orders, right? But you go on Amazon with a certain motivation. The only day in the year when e-commerce operates as a push modality, not as a pull modality, was last week, 11/11, the 11th of September, single day, which is the day in China where Alibaba and those platforms makes the most of their sales. Just think about it. In 1 minute, they made $1 billion sales. Okay, so this year they reached more than $40 billion in sales. Now, the Alibaba guys to whom I talked to know that 364 days of the year, the e-commerce is pull. It starts pull, but there's one day when it's very push because people go there just to check the best deal, right? Irrespective of what they might need. Now, when it comes to finance, it happens that there's very few people when they have some money to invest that will start Googling, is there an investment fund that is 30% US stocks, between 12 and 14 European stocks, up to 20% of Chinese stocks, but not those of Guangdong because they pollute the environment and I am ESG. It doesn't really happen. Very few people do that. So people instead tend to get into a conversation with someone. Why do they need a conversation? They need a conversation, as I said, because money is emotional, because it's linked to survival. The moment they put the money somewhere into an app, it's like they dispossess themselves from that money. And the money, yes, can generate returns, but it's at risk. That's why without a lot of marketing from the industry, people typically are not self-directed. So if a bank today digitizes fully, we lose the client. So the point is how to help them understand this pull and push mechanism so that they use technology to augment and support the role of advisors whenever is needed, or to give more value to those clients which are few but growing, that can be more self-directed in order to get the right motivation. Now, for a while, a lot of wealth management operations will be in hybrid model, so digital supporting the human advisors. There's just one condition upon which this can change, and this is due to the role of artificial intelligence. Because you see, the day artificial intelligence will be deeply and truly conversational, mobile technology will be transformed from being a pull technology into a push mechanism, and the circle is closed, which is, if you like, the attempt of Jeff Bezos with Alexa on the IoT. If you can build a trust with a AI-powered assistant to do grocery, which is very cool, one day you might be even willing to use it for financial transactions. It doesn't start in finance. It will have to start in e-commerce where the asymmetry of information is lower and then can actually transfer. I can't tell you when that will happen, if that will happen, but I can certainly tell you the condition upon which the world of banking can be fully digital. Now, the issue is that even though today it cannot be 100% digital, banks have a harder time in justifying the cost for the revenues, right? Which creates a problem in their business model. And in any case, that means to me that the only way forward is to rebuild the banking charter as a network of financial planners, use technology and fintech innovation to facilitate this transformation from transactions to services, making sure that the industry generates more transparent value for the clients. That happens through a conversation that generates knowledge. That's why you heard me talking about the digitization of knowledge many times. And this is really a impactful transformation of finance that can have a positive impact on the economy overall, because they can be the guiding principles to transform the economy on different purpose-based principles.
So in fintech innovation, you talk about goal-based investing and gamification, and you describe goals-based investing as the ultimate step in personalization within the journey of wealth management and innovation, which sits at the crossroads between classical portfolio theory and behavioral finance. So I know lots of our listeners might be using goal-based investing with their clients. Some may not be, but I'd be eager to hear your thoughts about why this is so important that advisors adopt GBI.
Okay, there might be guys that use the goal-based investing language, but not necessarily use the consistent framework. We have to say this also, because in order to do a good job, even the GBI needs to be agnostic in principle, right? If you plug inside your expert opinions, which are just opinions, though valuable opinions, the client will not be able to understand that nobody owns the market, and if he doesn't reach his goals in time, he will be upset, right? So there is a framework to facilitate decision making, is not the next self-fulfilling prophecy. But what matters to us today is the following. If financial markets and economies overall are becoming more and more uncertain, okay? So there's fundamental uncertainty which is climbing. The expert opinion around specific problems like products is not working that well anymore. And transparency is also forcing advisors and bankers to declare their conflict of interest in front of the client. So if you like, clients are left with a puzzle here, because the moment you are more and more transparent, the more they feel like they need to be self-responsibilized to make decisions and may not be capable of making that decision. So if we accept as it is that instability is the norm and fundamental uncertainty is key, we need to anchor our decision making to somewhere else. And the goal-based investing framework gives you that anchor, because it enables you to structure the conversation starting from the need of the client first, distinguishing between security, the Maslow pyramid, that can be housing, that can be in the end retirement, performance, because you don't want to miss out on the market, and final aspirations, because maybe you want to buy some bitcoins, hoping that you do it on a platform that is not scamming you. But this way, you build awareness in the way you relate to the problem. So is the need the structuring of the process that maps more consistently the way we should behave to build awareness in our investment decision making process. So that's why that's important. And I want to tell you something. The European Parliament asked the Econ Committee, which is the committee dedicated to economics research, to write a paper to address the change of guard of the European Central Bank, as Mr. Draghi left at the end of his mandate, and Ms. Lagarde took over as the chairman of the European Central Bank. Now, these economists identify three things that are relevant for the governor of the European Central Bank to consider. And the third pillar is called fundamental uncertainty. So basically, it tells them, look, we need to recognize that How we measure the economy in the past doesn't work anymore. The world is more and more uncertain. Fundamental uncertainty is key. You need to find a new framework to make decisions by bringing fundamental uncertainty as part of the process. Now, the way you do that is to build goal-based investing on agnostic simulation of the future return, structuring your decisions to make sure that maybe you don't know, but you don't get exuberant in your economic decisions because you make sure that you can preserve your safety net. And you see what is happening, unfortunately, today on the world stage that think about the GDP discussions. Yes, maybe America will grow 3% next year. But if that growth of GDP is not inclusive, that is not a progress for society, right? So all in all of my literature goes around the idea that as finance is looking for a new purpose and technology is trying to enter into the equation, if we make this with transparency on incentives, cost, and consequences, we can find a way to transform change into progress because people can better understand because even artificial intelligence is transparent and cannot abuse the relationship. You see what happened recently with the Apple credit card and the problem of the gender neutrality. And therefore, we do something which is very important. Adam Smith conceived the invisible hand in a world where the economy was more simple than today. Today is a very complex world, so the invisible hand has a harder time in working. And people say, well, capitalism doesn't work anymore. Now I tell you, financial market transparency can make the invisible hand visible again, so we can start building growth in a society that is more inclusive and reduces the impact on the planet, finding way to move, if you like, some of the reward to the next generations by accepting today the cost of fixing what we broke.
So that's a tall order, and I would feel badly about bringing our conversation down to something that's in your book around gamification or gamification, however you want to pronounce it, as another tool that perhaps can help us achieve some of these goals that you have in mind, or not?
Yes, because you see, as I said, money is emotional, right? Is not rational, which is the other problem of neoclassical theory, and somehow is also the problem of behavioral science, because a lot of behavioral scientists, not all of them, has been discussing the fact that you, for example, can nudge somebody so that is not irrational anymore and it becomes rational. But that is basically not possible. But what matters to me the most is that if that exercise needs to be paid by the client needs to become aware of the process so that they can remunerate it. Now, as uncertainty is growing, and uncertainty is what finance deals with, because risk is just a sheer approximation, how do you make people feel comfortable with uncertainty, knowing that our brain built mechanism in order to simplify the framework? That's why we fool ourselves in order to assume we know everything, so we move forward until the next market collapse. Well, we need to create a gamified mechanism that enables us to relate to the uncertain future. Now, I'm not saying that you need to play a game. We need to explore the principles. But when you play a game, basically, you don't know what happens next, right? So there might be a screen, a second screen, things that happen. You try, you fail, and then you learn somehow the mechanisms, the way you need to deal with the game, so you avoid of spending all of your credits at the very beginning because you may need them later on, and so on and so forth. Now, the gamification here is important because it is more emotional the way it works. And as money is emotional, it might give you a better way of connecting with the biology of people, refusing to understand that this emotional element is a powerful element because it is a warning element of our brain, leads us to the misunderstanding of the individual, to the over-rationalization of the problem, and therefore the final collapse. So the gamification is a way that you can use and build in order to better reconnect the emotional, biological element of investing with the reality of financial markets, which are very uncertain.
So we've covered a lot of ground. There's a couple things I want to just run by you. One is you mentioned the Apple credit card, and I think many advisors have perhaps a love-hate relationship with fintech, with robo-advisors. Some see them as competition. Others see them as you portray them, which is something to help them achieve their goals with their clients and to make them more efficient. But as you think of more technology companies entering the fintech space, big companies like Google also just announced efforts to move into the financial arena with, I believe it was a checking or savings account or something to that effect. And obviously, Google won't be the last. Amazon won't be the last. There'll be others joining Apple and moving into the space that others may feel threatened by their presence, or how should they view the big tech companies moving into the financial services world?
Well, you see, that is the real competition ultimately. And financial services need to be very careful because if financial services believe that volume is their strategy, volume means commoditized products. And as banking becomes more and more contextualized, the non-banking platforms have many more touch point with the final clients to basically facilitate financial transactions. But you see, convenience is not value. Those are two different things. So that's why instead financial services need to learn how to build a new value for clients by facilitating the variety of conversations that planning and advice can generate in order to protect themselves and their related clients to the sheer commoditization that the platformication economy can basically generate. Now, there's one issue that a lot of the technological companies did not properly understand. They thought that their role was to use big data in order to understand the markets or to understand the client and therefore to personalize the relationship. But this is not correct because that's about marketing. And you know yourself that investing, advice, and planning is not about marketing. There's something more important that needs to be played here, even when we look at data, is not that relevant for an advisor or a bank to understand their client. Not that it's not important, but it's not that important. The most important thing that comes first is that the client understands you, is that the client understands the value proposition because clients have a harder time in understanding finance. Big data does not contain the future when it comes to trading too. My Facebook profile, it is not necessarily me, it might be somebody else. So we need to move beyond that concept. And this was properly understood, I believe, by Jeff Bezos when he created Amazon. Because, and I mentioned it in my latest article on the American Banker, in the 1990s, for those in the audience which are my age, Facebook and Amazon was primarily a retailer on the internet of books, right? And I think it was on 60 Minutes that the journalist asked him, what's Amazon? You know what Jeff Bezos said? Jeff Bezos said, Amazon is not a distribution channel of books on the internet. So the journalist in the US was puzzled and he said, you're not a distribution channel of books? And he said, no, because listen to this. He gave him this story. The publishers were sending him letters complaining that he was publishing positive and negative reviews about the books. And they told him that his marketing stupid, only publish the positive reviews, the positive story. So there is more sales on the platform. But Jeff Bezos said, you don't understand. You're not my client, dear publisher. So he said, my client is the person that comes on this platform to buy the books. And my role, he said, is not to be a distribution channel of books. I open the bracket, is an advisor, is a planner, is a bank, a distribution channel of financial products on digital? So Jeff Bezos said, that's not what I am. He said, my role is to advise my client on which is the best book to buy, because as he cannot touch it, he doesn't know. So the negative and positive reviews give him comfort to trust the platform. in order to make a decision. And once that is solved, he said, I can use other analytics in order to operate on a platform. Now, I think that a lot of guys in the big tech community and somehow in the fintech community did not understand this simple concept. First and foremost, help your clients understand the value proposition. Only after, think on how you optimize that value proposition around the client. Because if you miss the first, you cannot succeed on the second. And that is exactly the role of a good financial planner or financial advisor. Help the client understand what it has to be understood in finance and the value proposition first.
So I mentioned that we have covered a lot of ground. Are there some things that we haven't touched on that you think would be important for our listeners to learn before we sign off?
Well, I'm a very optimistic person. I know businesses are difficult. I know economies are difficult. But I think that if we all commit to the attempt of understanding value and becoming more transparent, we can therefore ask our counterparts to be transparent. And transparency turns change into progress. So I hope that today we will have more impact in the economy by building more transparent wealth managers that contribute to the generation of progress.
Well said. Paolo, I can't thank you enough for being on the podcast and sharing your wisdom with our listeners. Hopefully you'll come back on another podcast after maybe your next book or when you come back to the States.
Anytime. I'm really flattered to talk to your audience. I know it's an amazing audience. Thanks for having me here today.
Yes, thank you. My guest has been Paolo Sironi, an elected member of IBM Industry Academy and author of several books, including Financial Market Transparency. Thank you for listening. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit our website at investmentsandwealth.org to learn more about our certifications, conferences, online learning, and continuing education programs.